What's up, everyone? Welcome to another video. This is Dan here once again, and we have some big selling on the S&P 500 the past several days. We have had some gaps down, several gaps down, and there's some big selling going on. It looks like the trends are changing. It looks like we're going back into the bear market. So I need to give a quick update. We're going to check out all the macro indicators that follow the macro environment and see if this sell-off is warranted, see if we are flipping back into a bear market. So let's jump right into the charts and see what's going on. All right, the first thing we're going to look at is the S&P 500 index because it looks like the trends are changing. We've been in a nice little rally the past couple months, a little over the past couple months, and now it looks like we're selling off below support of this uptrend. Things are starting to look like they're getting bearish. We have some nice high relative volume to confirm this sell-off below support. And when I throw up the 200-day moving average, which is a strong support or resistance level, you can see that the selling is happening near this 200-day moving average. That's what I just highlighted there. And when I throw up the capital flows on the chart, that's what you see over here on the left where I'm highlighting. You could see this massive outflow of capital that happened last Friday. That was actually a witching Friday, and these are block orders that we're looking at. This is smart money exiting big orders, basically. And on top of that, Powell said that he's going to keep interest rates high for longer. He said more hikes are necessary. So this downtrend looks like it is getting confirmed technically with all the data and with all the macro stuff going on with Powell keeping those interest rates up higher for longer, like he said once again. So it looks like we're going to be in a downtrend. It looks like the trend wants to go bearish, just like it has been in this bear market. So is this a real change in trend? Are we going downhill from here? Let's check out the other macro indicators and see what's going on. Now, the first thing we want to look at to get confirmation of the bearishness in equities is the US dollar index. There has been a very strong inverse correlation between the dollar and equities lately, especially in this high interest rate, high inflationary environment where the Fed is hiking rates like crazy. And basically, the dollar is in this downward wedge or price channel, whatever you want to call it. The dollar is still showing downward pressure. We have technically not broken above this support or the resistance line that I'm pointing out right here. Until the dollar can break out above that resistance or at least start showing some upward movement here, this thing is still pointing down. So that should be bullish for equities if you're just looking at the dollar at this point. And that breakout to the upside could happen pretty soon if we're just sitting at this resistance line here. We could break out overnight or in the morning, tomorrow morning, I should say. But at the moment, the dollar is still pointing down, and this is after a massive rally all year long, and also this giant sell-off that you could see here, those big red candles, we're still pointing down from there. So the trend on the dollar is still technically down. And in the current environment, if the dollar goes bullish, then that will be bad for equities like the S&P 500. The next thing we're going to look at is treasury yields because there has been somewhat of an inverse correlation with yields and equities lately. When yields have been skyrocketing with Powell increasing interest rates, then equities have been dropping in a big way. So we'll check out the 10-year yield here. That's what you see on the chart. The yield started downtrending with the dollar right on cue, which brought equities up over the past couple months. And similar to the dollar, the 10-year yield's right at resistance of this downward channel. It could break out to the upside. If that gets bullish on the 10-year yield, that'll be bad for equities. And I should point out the 30-year yield here. This is a much longer term yield. It looks like this one's already breaking above resistance. This one's starting to get a little bullish. Powell said higher interest rates for longer, so the longer term yields you would expect to show signs of that. Investors should be selling off their treasury bonds in anticipation of getting a higher yield in the future, and that's what you see when you see the yields increase. When they're selling their treasuries, then the yield's going to increase. It's just an inverse correlation like that. We don't need to get too far into that. So watch out for the 10-year yield to break above resistance, just like this 30-year yield here. We'll see. That would be theoretically bearish for equities in the current environment, or at least in the current trends that we've been watching on these charts over the past several months. The next ticker we're going to check out is VIX. This is the volatility index. Basically, if you know the VIX, it's the put to call ratio. When the VIX is going up, then the market, like the S&P 500, is generally going down. And you can see when the VIX was falling here over the past couple months, the market was rallying pretty hard, and it looks like the VIX is climbing again. It's definitely out of that downtrend it's been in the past couple of months, so the VIX is starting to look bullish, and that's not good for equities, right? That's bad for the SPY. So keep an eye on the VIX. If it starts skyrocketing, then we're surely going to be seeing the market falling at the same time. And I should mention quickly, when we zoom out on the VIX, this from a technical standpoint, this is a strong technical support level for the VIX to bounce. It's had some bounces in this area in the past, and when you look at it, you can see the VIX is just range bound within these highs and lows here. It's stuck in this price channel. And you don't want to fight the trend. If the trend is a price channel, then you should expect VIX to bounce at least a little bit. There'll be some investors waiting down there to buy at support, you know what I mean? So just watch out for the VIX to keep climbing. That'll be bad for equities. All right, the next ticker we're going to look at is LQD. And this ticker basically tracks the corporate credit of liquid companies, companies that have really good credit and bad financial times. LQD's ticker, I mean, if investors are buying their corporate credit and they see that economic times are not going to be bad in the future, and that's what they've been doing the past couple months. While the SPY was rallying, LQD was rallying with it. People were buying up corporate credit and equities. It was looking really bullish. But when we zoom in, you can see it looks like some selling's coming in. It hasn't sold much at all in the past couple months. It's been rallying really hard. We're below a support of this little tiny topping pattern, you could call it here. It looks like a little head and shoulders. So if corporate credit continues to sell off, then investors are assuming that economic times won't be as good in the future, and the credit ratings will drop or something like that, man. If they're investing in these companies, they expect to get their money back, and they will not be investing in this stuff if they're expecting a recession. So when you see a sell-off in corporate credit, it should translate negatively into equities, and that's exactly what's been happening over the past several months. So keep an eye on these ticker symbols like LQD, HYG, all those corporate credit ticker symbols that track the corporate credit of. And quickly want to go over TLT. This is long-term treasury bonds, 20 years plus. I like this ticker symbol because it's super liquid and it's easily, you can trade options on it. It works well. And you can see the selling happening here as well. We dropped below a long-term support level I've highlighted. And it looks like people are selling the long-term treasuries because the central bank, PAL, banks all around the world said they're going to keep hiking rates. And if they keep doing that, then you can get a higher yield than is currently available. So they're going to be selling their treasury bonds in anticipation to get a higher yield. And again, when we see them selling their treasury bonds, you'll see the yield of treasury bonds increasing. That's that inverse correlation there. So if you keep seeing these treasury bond ticker symbols drop like TLT, then that is investors selling their treasury bonds because they assume the Fed's going to keep increasing interest rates, right? And usually the bond market is a more global market, and they usually have a lot more of the smart money involved. So when you see treasuries selling off, you got to think something, especially if you're holding on to a bunch of equities, right? Because the higher the Fed increases these interest rates, it increases borrowing costs for companies that we invest in on the S&P, and that's negative for profits, and essentially that'll be a negative bearish for the equities. And I quickly want to go over gold futures. They have been on a strong rally as soon as the dollar started dropping. Those big red candles I showed you earlier, here's the big green candles on gold. And gold started rallying as soon as the dollar started dropping. It seems like it was traveling up this wedge pattern here. We recently broke below support of that wedge just at the same time as equities started looking bearish. The inverse correlation between dollar and gold is similar to the inverse correlation between the dollar and equity markets right now in this environment we're in. So if we see gold start dropping, that's going to confirm the bearishness in equities. If gold starts climbing, then we got to think twice about our equities bearishness. Sometimes they don't exactly correlate, but it's just another factor or variable to look over. So just keep an eye on the dollar if you're invested in gold. When the dollar's climbing very strong, then the strength in gold will not be so strong. It'll weaken gold, definitely. So watch out for that. And one other macro indicator I want to quickly go over that I've not mentioned in many of my videos is the Japanese 10-year yield right here. Now, the Bank of Japan has had a bond buying program where they're just buying bonds, an unlimited amount of bonds to keep the yield below this level here. It's around the 25 basis point level. And every time they buy up bonds to make this yield drop, then they are using a ton of Japanese dollars, and that decreases the value of the yen, which makes our dollar skyrocket. That has really been lifting up our dollar in this past bear market, and when the dollar gets lifted, that hurts equities in a big way. And you can see the yield has been hovering right around this peg mark that they do not want it to go above. So will the Japanese government start buying up bonds again, bring their bond yield down, and make the dollar skyrocket, which is bad for equities like the S&P 500. They do have some economic data coming out, a policy meeting. I don't think it's a policy meeting, but the Bank of Japan is going to be talking about if they're going to continue this unlimited bond buying spree or not, let the bonds continue a little higher. Now, if they do say the bonds can continue higher on this next meeting or whenever they talk coming up soon, and that is actually happening in a few hours after while I'm making this video. I hope I can get it out before. But if the Bank of Japan says they will let that yield go above that 25 bips point, then that will be bullish for the yen, which will be bearish for the dollar, and that should help lift equities if my theory is correct. So watch watch all the talks coming out from the Bank of Japan coming out in a few hours. And that's basically all I've got for this broader market update. We just went over all the macro ticker symbols to watch when you're trying to see which direction the market when it goes. It looks like we're turning over. The market wants to change the directions, but we'll find out soon. We can't confirm this bearishness just yet. It's at least only been a couple or a few days below support, so we'll see what happens, but I'll update you when anything changes. Other than that, guys, thank you for watching. Hit the like, leave a comment, subscribe, all that good stuff. I'll see y'all on the next video.